one of the challenges in hearing other people's stories is they're just not that interesting. They're hard to replicate. They're hard, like everybody has their own story, and everybody's story is interesting. And I just find my story to be random. And I grew up watching the deployment of the internet, and that was what, as a kid, I fell in love with. It was AOL and CompuServe and Prodigy, which attracts all the old people in the room, and the young people have no idea what I'm talking about. And then the web. And I just saw that as a kid and found that to be something that was fascinating. And went to college as the internet went up and all the way down. I was back to eBay. I was one of the first 100 power sellers on eBay, which meant they sent you a T-shirt in the mail. So I have a T-shirt. And I was buying and selling baseball cards, which probably is as good of an asset class as early stage venture. So I could have stuck with that. And I had no idea about the word venture capital. The word entrepreneur was not prolific until probably the past 15 years when it got integrated into universities. And so to me, we invest in dreams. We invest in people who have dreams to go build something. And when I think about BoxGroup and what our job is, it's to meet people who want to, it's cheesy, but change the world. And they want to change the world in little ways or big ways. And hopefully they're big economic impacts, but I think it really is about that seed. And so I went to college, and then I went to law school. I hated being a lawyer because being a lawyer sucks. Spent a year in real estate finance, and I left to start a company. I failed miserably. Alan claims we met around that point, but I don't remember him, and I guess he remembers me. So no offense. Sold myself to a big company where I put my title as head of internet, which is a sign of a dying company when they have that. It was 2007 to 9, and they were printing cash but walking off of a cliff because they charged for information, and there was the internet that was going to be free for information. And I got to build startups within this big company, and it was a free lesson for 2 years in terms of building internet products, but also in terms of me knowing I was a terrible employee. And left there, ended up meeting the founder of Techstars at the time, which was a nascent accelerator in Boulder, Colorado, and Boston. Y Combinator had just moved from Boston to San Francisco, and New York was in the beginning of this nascent entrepreneurial moment where there were a handful of interesting companies and a handful of people that really had chosen not to participate in the normal industries in New York, and instead were doing internet stuff. And it was curious to me why there wasn't more infrastructure getting built to help that. And so I launched Techstars in New York in 2009, spent 3 years there, and BoxGroup was my way of investing outside of Techstars, primarily in non-associated companies. And after 3 years at Techstars, I looked at the companies we were investing in at BoxGroup and thought they were more interesting than what we were doing at Techstars, so I left. The real story is we had an intern in my third program at Techstars that we paid $1,000 a month to be an intern. And he was a great intern. He had won an award at Bain previously for most hours worked, which is a pretty dark thing to have accomplished. His job at Techstars was like help the companies, and everybody fought over getting him to help. And after the program, he's like, I'm working on my own thing. He started working out of our office with a friend, and we asked if he wanted to do Techstars for our next batch, and he said no. And I said, why? He goes, because I don't need it. And I thought that was a good sign that this wasn't what I should be spending my time on. That was Zach, who started Plaid, and so he ended up investing in Plaid through BoxGroup right around the time we left Techstars. So been about 12 years building BoxGroup, first 9 years, we didn't have LPs. And so I'm now 5 years into LPs.
Great LPs. What was the original strategy when you started BoxGroup? And if and how it has evolved over time?
We didn't really have a strategy. I think I spent the beginning part of my career talking to as many investors as I could and just trying to find what resonated with me. And there's a couple sound bites that I just stuck with me, like investors invest, and it sounds dumb and simple, but the amount of investors that spend time with founders and say no and build a reputation for that is real, and it impacts your sort of brand with founders. And I think that that's sort of first and foremost. And then invest in people. And again, it sounds super simple, but if you're going to be an early stage investor, I think you have to really take that to heart. And so if I look back at a lot of the mistakes we've made, we try to outthink the market or the product or something beyond team and people. And I think I started there. It was 2007 when I made my first investment, 2009 and 10 when I really started scaling. And the sad part is, if I've basically done this analysis, if in 2010 through 12, I said yes to every meeting I took, I would be better than I am in that period. It was just like timing matters. And so if we had just literally said yes to everything, we would have better returns than we do, which is a shitty way to feel about your career. And so I think we started with those two premises of fund interesting people working on interesting things, and that hasn't changed. We've scaled capital, but the strategy in our first fund, it was a $10 million fund. It was 152 investments, which is a different strategy than other people. Our current fund is a $200 million fund, and it'll be about 150 to 200 investments. So scaled capital, but not really changed the strategy.
Mm-hmm. And so what do you think differentiates you from other funds? How do you cultivate relationship with funders to stay competitive and build your deal flow and brand?
I think VCs are selling money.
Something.
We're selling money. It's a weird thing to sell. And I think everybody wants to make themselves out to be this magical value add. And I just don't think that that's that interesting. Sequoia is, no offense to everybody here, Sequoia is better than you at value add. And I mean that with sincerity. And so you can either choose to operate outside of where the multi-stage players are playing, but I would argue that they're pretty good at playing everywhere, or what we try to sell is us, and we want people to like us. And I think we win deals because people like us. And what does the word like mean? It means something different for everybody. And so our job is to build a relationship with a founder to the point where they want to talk to us and they want to work with us. And a lot of that comes from reputation and them asking people who they know who've worked with us if they should work with us. And so we are only as good as our worst reference. And we have 750 active companies or somewhere in that range, and that's a daunting thing to maintain, is 750 different groups of people liking you. And I think that's why people work with us, is they choose us over other people. It's very rare that we're meeting an entrepreneur that doesn't have a choice. And especially in this market where there's a lot of people chasing a small cohort of high potential opportunities, you have to win on begging, borrowing, and stealing more than you do on like this magical operational value add.
So you have to be good at see, pick, and win. But what differentiates you? Like, you see more, you pick better, you win?
We have to be great at each one of those things. I think we obsess over seeing. Our entire model and our entire business is predicated on seeing something. I think we lose sleep and we panic over not seeing something. Every day when we get the newsletters of what got funded.
FOMO.
Yeah, enormous FOMO. And we try to figure out if there's something that we wanted to see, why we didn't see it. And we try to spend effort seeing. I don't know that you can get better at picking in your career. I think at some point you max out on improving. And I'm old and I've been doing this a while, so I don't know that I'm going to get better.
You're not that old.
I'm pretty old.
No,
but
I'm
don't
older
know,
than you, so you are young.
I don't know that you can get better at picking because the results are so far removed from the decision. So like we made an investment yesterday. I will know if it's bad in probably 6 months to 2 years. I will know if it's like probably bad in 3 to 5 years. And I will know if it's good in 5 to 15 years. And so that feedback loop doesn't then inform the go-in motion. So how do you get better at something if you don't know if you were right or wrong until like there's a new regime in 10 countries around the world? It's like a fundamentally decoupled in and out process in venture that I think is really hard to then attach to picking. Winning to me is tactical, and I think that changes in different market conditions. I think our job is to win. I think we at BoxGroup have built a style of investing that enables us to win in a different way than other firms because we're not leading the majority deals. We're not sitting on boards.
You don't compete Sequoia.
We play with. We view ourselves as a Switzerland in an ecosystem where everybody fights each other. So we call ourselves an and firm, not an or firm. You can pick someone and us and not someone or us. It doesn't mean that there's not a fight for allocation or a fight for check size, but I think we've set up a strategy, and it really is rooted in that origin of we want to be able to invest in the things we get excited about, and if we need, which is a fake word in venture, a certain ownership threshold, and operate with that mandate, we're not going to be able to invest in the things we're most excited about.
Mm-hmm. Let's talk about your team. Looking at your website, you have 9 people who are called investors. No one is called a partner, and there is no...
You put a partner on my title.
My mistake.
Yeah.
No one is called a partner except for you, and there is no apparent hierarchy. Is that optics, or is that true in decision-making and economics?
Everyone at our firm can make a decision on their own without... no, I have a couple LPs in here. We'll talk about that separately. But we have 9 investors. Everybody can do what they want. My job is to have people on my team that I trust to make good decisions. And so the goal is not for everybody to make random decisions, but to enable everybody on the team, if they see something that excites them and there's a tactic that says, in order to win this deal, we have to do this right now on my own, everybody's empowered to do that. We try not to operate like that. But this market, especially at the seed stage, especially in highly competitive deals, is rapid, it's fluid, it's agile. And if we don't adjust to the market conditions, we're going to have a disadvantage. So that sort of applies to win. We operate as an organization. We don't have any internal economics associated with deals. And so everybody is incentivized as a firm. And so we work collaboratively outside with other firms, with companies. And if we then compromise that internally, it would feel totally disconnected. So every deal's a BoxGroup deal. Everybody is allowed to do what they want. If our newest, most junior person is making a lot of investments on their own, then we should probably
15 years.
LinkedIn will be demoted to something else.
I heard you on an interview you gave to one of my competitor interviewer, Stebbing. You said that seed investing is more like art, and later stage, no offense, is more math. So if it's about art and human. And how do you stay consistent across the team? How do you maintain BoxGroup's culture and success?
It's really hard because it's totally, like, early stage investing to me is totally subjective, and then one day it becomes objective. And so again, back to like go in motion, it's did we get excited enough about this company to say yes? And then you have to explain it to somebody, and it's messy. You're like, I funded this thing, it's really early, it's 2 people, we're paying a stupid price because the market is crazy, and it's probably not gonna work. And then you fast forward like 10 years and you're like, I knew it was gonna work, it's a huge company, and that's the decoupling of early and late. I think at late you're able to look at traction, you're able to look at numbers and use that to create a mentality to say yes. At early, there's just not enough stuff to justify the decision. You can like fake it and package it so that you feel good about it, but I think it's art. It's I like this enough to say yes versus I don't like this enough to say yes. And I think as an organization, we use in our deal meetings, which we don't vote.
And you don't have an office, right?
We have an office. We have art in the office too, but we don't vote. But what we try to do is help the people that are thinking about that deal get to a yes. And I think it's a different mentality than a lot of firms where you're sort of trying to figure out how to say no. Figuring out why to say no to an early stage company is the easiest thing in the world. If you hear the idea or you meet the company, everybody can identify why it's not going to work. It's probability-wise, 95% or higher not going to work. So having to explain that isn't the hard part of the job. The hard part of the job is squinting and seeing why it could work, and then figuring out how to get yourself to enough conviction, which is a funny word at early stage, to say yes. And so what we did, and it really happened probably in like 2018 or 19, we started finding ourselves in meetings. We have 5 minutes left. Figuring out how to, we called it grenade other people's deals, because it was easy to do that. And so we banned that in our meetings. And now we try to help each other find the path to yes, because the cost of omission in our model is so much higher than the cost of commission. If we miss 5 deals in a cycle that could return our fund, we suck. And so we can't miss those deals. And it doesn't mean we say yes to everything. We look at about 100 deals for every one we say yes to. So back to deal flow, we're predicated on high quality deal flow, but it's about finding that one company in that noise that we're excited enough about to say yes.
So you put a lot of emphasis on the C. It seems that, especially after COVID, founders have better access to investors. And how does BoxGroup stay ahead in increasingly competitive venture capital landscape? It's getting harder every day.
Yeah, so I think sort of right around 2019, right before COVID, and then really coming into COVID, the early stage market fundamentally changed, and I don't think it's been appreciated enough. The multi-stage firms have grown, and they've gotten more agile, and they're more accessible. And so sort of historically, if you wanted to meet with one of the big firms, you had to go fly out, sort of pay your dues, go kiss the ring on Sand Hill Road in an in-person meeting on a Monday. And sort of right before COVID and then really coming out of it, all the multi-stage firms have gotten just amazingly more agile, where they can spin up a partner meeting on Zoom in real time. And they also all raised more capital and shifted earlier in their focus. And so across the board, we just see over and over the multi-stage firms sucking air out of the seed market. And so if I go back, 10 years, let alone 5 years, it was an anomaly to me that the multi-stage firms were around the table in competitive seed deals. And now if they're not, I assume that that deal has been passed on by all, if not most of the multi-stage firms, if they're not there. And so when we look at the competitive landscape at seed, it is dominated, and this is mostly in the US. I have no idea about other places because we don't look there mostly. And the multi-stage firms have just become a force, and I think that's because the competitive dynamics at Series A and Series B have changed amongst them, and they're willing to take less ownership just to get in a deal, because they're not going to, there's one winner at Series A and there's one winner at Series B, so seed becomes another playing ground for them to try to get some access and ownership into a potential winner. And we're seeing that, and it changes the size of rounds, changes the valuations, and it changes the competitive dynamics.
So let's finish with, how do you see the venture capital industry evolving in the next 5 to 10 years? And do you think AI will change things for the VC ecosystem?
That's a loaded question.
And no pressure, you have a minute.
Yeah. I try not to think too far ahead because our job is to wake up tomorrow and find a founder that we're excited about and give them money. And I think like see and win are day-to-day things, and pick is this overarching thing. I think there's consolidation happening. I think the LPs can express frustration with the scale of multi-stage firms and the scale of how they're approaching return profiles in venture, but they're very good at raising money and they're very good at deploying it. And I don't know that that's going to slow down overnight. And so I think the competitive landscape at early stage continues to feel harder and harder because the big firms are getting better. And I don't know that there's some magical thing that's going to stop that. It would be lovely if we had less competition, but I think that's a stupid thing to bet your career on. And so...
but AI will...
AI, we have 10 seconds.
No.
AI, you guys, you should lean into AI. No, I don't know. We get asked, like, are we going to get replaced with AI? If so, like, I hope I'm retired.